Hello everyone and welcome back to another episode. My name is Jordan. I'm a millennial investor and today we're going to be going into the dividend growth portfolio in M1 Finance. I love this portfolio. I love editing it, and if you've been following me for a while, then you know one of the top holdings in the portfolio, tied for second place, is ticker symbol WPC, WP Carey. This is a great company. In this video, I want to go over the basics. I want to reiterate why I love this company, go over many different bullet points talking about the property leases, how they're financed, how they're diversified, both geographically as well as industry diversification, some of their top tenants, look at other things like how they do their asset management, as well as their dividend structures, and other things like news and how they run their company, and overall just how I love it. And as well for the end here, we'll also say the performance versus this company versus the S&P 500. But overall, just in general, we're just going to give a brief overview of this company, talk about why it's one of the biggest holdings in the portfolio, and why I think it has lots of room to run in the future, and why I think it's going to continue to stay one of the top holdings in my portfolio. If you guys haven't checked me out before, my name is Jordan. I'm a millennial investor. In the description down below, we have opportunities to get signed up with M1 Finance, and you get $10 for doing so. 124 people signed up so far, so if you'd like to do that, I'd really enjoy it and appreciate that if you do that, as well as other things down below in the description, including auto savings accounts, credit card referrals, and mentoring sessions opportunities with me. But other than that, guys, let's jump straight into the video and start talking about WP Carey. Now, WP Carey, if we jump into Qualtrim here, we can see that it currently trades at about 88 bucks, and this company currently has a dividend yield of almost 5%, which is dramatically higher than the average in the market right now, which is dramatically different. The revenue of this company, let's put it on an annual chart, because this company originally went public in the late 90s, and if you look at it on an annual basis, it really becomes apparent. In 1997, producing $98 million in revenue, and then the most recent year producing $1.3 billion, and pretty much, other than little offset years like the 2008 recession, pretty much this has been a straight line up ever since. And even last year putting up record numbers, and then as of the most recent quarter, just coming a little bit off the highs, but still near record levels. In terms of profitability, we have pretty much the same thing. The free cash flow near record levels, producing about $200 million in free cash flow every single quarter. And the net income, a similar story, producing a couple $100 million every single quarter. Now that's great, but that's past performance. Now we need to talk about future performance. Now, if you're not familiar with me, I like to show my portfolio and show my examples and show how I've done, how I'm doing, where I'm going forward in the future, and I don't like to just look at past numbers. It's very easy to look at this and extrapolate it into the future and say they're going to keep growing. Okay, maybe, but what are you basing that off of? Well, let's go ahead and jump straight into the investor relations page. Well, first off, this company has many different properties diversified all over the place, which we'll get into in a second. And real quick, I just want you to look at these bullet points, take a screenshot in your head, and remember these numbers because they're very important, specifically these two. The first one being occupancy rate, meaning out of these 1,390 properties, 99.1% of them are leased out. So what is that? That's about, if I'm doing that math right in my head, like 12 or 13 properties aren't leased out. Other than that, over 13 and like 75 or whatever are leased out. So basically all of them. And then leases with rent escalations. If you are not familiar with what that is, when the CPI goes up and inflation rises, rent goes up alongside with it for almost basically all of these contracts. Every single property that they own, at least 99.3% of them, goes up alongside inflation. So if inflation is roaring higher at 10%, this company is raising its rents a considerable amount, if not a matching 10%. So that's good to know in a times like now when inflation is sky high. Now, in terms of diversification, let's jump into this. Geographic diversification, first off, we have the bulk of the revenue coming from the United States, which is what I want. I do want this company primarily focused in the U.S. Obviously, being based in the U.S., I'm biased. That's where I want it. But I would like this company getting revenue from other sources, not 100% for the U.S., but I wouldn't like it either if it was, say, 20%. Now, that has 64% coming from the United States, 33% coming from Europe, and the remaining 2% coming from other. Now, in terms of property type diversification, you have different industries like industrial at 26%, warehouse at 23%, office at 19%, retail at 16%, self-storage net lease at 4.6, and then about 9% left in other. Now, this is important, which we're going to break that down a little bit further here, is that let's say if you only had one category, say if you only own gyms and movie theaters, just as an example. During a time like the pandemic, this company would have been hit much harder if they only owned movie theater chains. That wasn't the case. This company owns all different types of properties, from agriculture to industrial to warehouse to retail to all different types of stuff. And looking at the actual industry specifically, it has 20% retail stores, 8% consumer services, 6% beverage and food, 6% automotive, 5% grocery, 4.7% healthcare, 4.6% cargo, 4.2% hotel and leisure. This is an example. I want to pause right here real quick. Hotel and leisure. That was an example of a unique situation in the recession in 2020 where hotel and leisure got hit very hard. I'm assuming, I could go back and look, but I'm assuming WP Carey did not collect a lot of rent from this category. Good thing it only makes up 4% of the portfolio. If this was 80% of the portfolio, they would have gotten destroyed. Next, we have 4% of construction and building, 3.6 business services, 3.6 capital equipment, containers, packaging, glass, 3.5, 3.4 durable consumer goods, sovereign and public finance at 3.1, 2.6 in high tech, 2.3 in insurance, 2.1 in chemicals, and then 1.8 at non-durable consumer goods, 1.7 in banking, 1.4 in metals, 1.2 in aerospace and defense, 1.2 in telecom, 1.1 in advertising, and then the remaining other at 3.4%. So I'll slowly scroll through all of these, so if you want to look at them again for yourself, in case, once again, you want to take a mental picture and get an idea. And you can obviously find this on their investor relations page. WP Carey Investor Relations is all you got to Google, and you can pull up these type of charts right here. But next, I want to go to the portfolio map. I won't go over this very long, but this just shows you on a weighted scale, if you want to see it on the actual world map of where their properties are, down to the specific country, you can do so. So all you got to do, if you go to the investor relations page and you just click a country, like say you click Norway, it shows the properties that they have, the rent that they collect, and the details behind it. Or if you want to click Spain, and you can keep on going further, as well as the US, of course. Now, if we go to the next tab here, and we go into the top 10 units. Now, I don't really care about these companies specifically, but I just want to show you diversified that these companies are. These are in completely different categories, like Marriott being a hotel, U-Haul being a self-storage / moving company. You get the point. You can look at these, Advanced Auto Parts. A lot of these you probably know by name, Extra Storage. It's kind of surprising to see that as a top 5, actually. But yeah, there's a top 10 units if you want to screenshot that or look at it yourself. Now, the dividend policy. What I'm going to do is I'm going to move my mouse up slowly, and we're going to go through the dividend policy since this company has went public back in 1998. Now, this company has consistently raised its dividend. Under that second to last column from the right, you see right now where we're on the screen, it's about 45 cents a share every single quarter. You can see that over time as I go through the years, this continually goes higher and higher and higher and higher. It is absolutely incredible. Even paying out sometimes special dividends, this company consistently raises its dividend pretty much all the time, 24/7. Now, over time, this company raises its dividend, but on most cases, most companies raise their dividend annually. While this company has had a track record of actually raising that dividend pretty commonly, raising it every single quarter. So you're not having to wait 365 days for a dividend raise. You're only having to wait about 90 days for every single dividend raise that you receive. And as you can see, as we're getting closer to the newer years now, we were originally going back to about 40 cents or so. Now we're well over $1 and getting to today's most recent 2022 payment in June of this year, paying out about $1.06. That is dramatically higher than what this company was paying out in 1998. But that's not all. This company has also had great performance. And as you can see, once again, if you want to see the schedule of this company's dividend payments, you can just search here, go to M1 Finance, click 5 years. And these little dividend charts right here, you can see when they're paid out and how they're paid out to investors. Now, going back here, if we look at their most recent investments, now, what I want to show here, I don't even really want to read the article. Because here's the thing, I could show the most recent investment that they made. It's very small relative to the portfolio size. Obviously, they've owned most of their buildings for decades. The reason why I find this so important is the way that management discloses things. So many times with a real estate investment trust or really any company, it's hard to know where their money's going, what they're actually doing. And something that's really cool, if we jump into Qualtrim here, I want to show you an example. A company that I'm invested in is Amazon. Amazon is a great company, and if we go to their expenses tab here, and we go to research and development, right here, this blue line, this company spends a fortune. I mean a fortune. Let's go to the annual chart just so I can display how dramatic this really is. If we look on an annual basis, we take off CapEx, S&M, G&A, and go to R&D, research and development. Last year, this company spent $56 billion. That's right, $56 billion in research and development all just on this company just investing back into itself into the future. Will that return money back to shareholders one day? Maybe, maybe not, but that's a risk that you're taking. Now let's go to the annual chart here and let's pull up this company's research and development. Take off these three, go to R&D. The number is zero. $0 in research and development. This company is very lean. It doesn't have any money going into R&D because it's very simple. They buy real estate, they rent out the real estate, they collect the profits, and that's what causes this massive free cash flow and revenue to go up over time. Pretty cool, right? Not wasting any money whatsoever. Furthermore, management is really good about disclosing what they're doing with their money. If you're saying, okay, this company did good in the past, what are they doing in the future? Well, you can read articles such as this one. Once again, if you want to go read this yourself, you can find it on the investor relations page. But it gives you an idea of the type of properties that they're investing in. And they give these type of updates all the time. They'll say, hey, we spent $10 million on a gymnasium that we bought. Hey, we spent $50 million on a manufacturing plant. All different types of examples that this company will give you. Now, in terms of portfolio performance, once again, this is a past indicator, not a future indicator. But what I wanted to show was two different things here. This first chart, okay, this is WP Carey versus the S&P 500, right? This is a $10,000 investment into both when the company went public in late 1998, okay? Now today, including year-to-date performance, as of a couple weeks ago at the end of July, you would have had 33,000 in the S&P and 45 in WP Carey. Now, respectively, that is 6.6% CAGR for WPC and 5.2% for the SPY, okay? About 1.5% difference. There's one thing I didn't tell you about this chart, is that this is not dividends reinvested. This is without dividends. This is with dividends. The S&P goes from about a 5.2% return to a 7%, but WP Care performance goes from about a 6.6 up to a 13.8. Your $10,000 investment in 1998 is now worth over $200,000. Just straight up sky high returns, and this is not, again, once a future performance. This could be way better, way worse. This will only tell you so much about the company, but I still think it's important to show. Looking at portfolio income, the amount of actual cash you're receiving from your portfolio, this is the dramatic difference. You don't have to rely so much on a stock price going up. Even if WP Carey, let's look at the 5-year chart again. WP Carey over the last 5 years is only up 30%. That's not bad, but in a 5-year return, that's not that great. But what they have done is consistently paid out 4, 5, 6% dividend yields consistently, even today paying out about almost a 5%. Now looking at the portfolio income, in 1999 you would have received $118 on your $10,000 investment in the SPY versus WP Carey's $800. Going into last year, 2022 still going through, but last year, the last calendar year that we had available, S&P 500 would have done about $700 in income versus WP Carey's $9,400. A pretty dramatic difference. Your $10,000 investment now, today, going back 1998 to today in 2022, by the time this year finishes out, is going to be around your original investment, $10,000. So you're likely going to be receiving dividend checks the same amount that you invested in the company. So overall, it's a company I like. It's a company I believe in for the future. I think they're going to do great. I think they are still doing great. I love this company. It's one that's been one of the top holdings in the portfolio pretty much forever since I started my YouTube channel back in April of 2020. But it's a company I like. It'll likely stay at a very heavy weighting in the portfolio, and I really doubt you'll see me sell it anytime soon. But other than that, guys, thank you so much for watching. Check the stuff out down below if you found it interesting. If you found it helpful, subscribe and do all the stuff that's referral links and all that good stuff. You know the drill. Go ahead. But thank you guys so much for watching, and I'll catch you guys next time.